Hi guys, welcome back to the channel. My name is Dave, and today I have a question for you. How much growth can you afford? We've been talking a lot about covered call ETFs recently. We're talking to fund managers, doing reviews, but are these right for you? Today I hope to answer that question. If that is what you're looking for, please stick around. Whoop. So first of all, I do own some covered call ETFs, so I'm not the anti-covered call ETF guy. I just believe that the core of my investing should be with low-cost index funds. And outside of that, maybe I'll buy some covered call ETFs. Maybe I'll buy some individual stocks. But for most retail investors, the best thing to do, low-cost index funds. Buy VOO and buy it again next week and repeat this process. That works really well for the common everyday retail investor. Now, above and beyond that, covered call ETFs tend to underperform their underlying and they have a higher expense ratio. This isn't great for us, right? That's not good. And then when it comes to yield, I put this in the category of things that don't matter, right? If a stock you own announces a 10-to-1 stock split, guess what? You have 10 shares for every one and they're worth 1/10 what they were worth before. It does not matter. Just like a reverse split. Like if a yield max fund comes out and they've been distributing too much and they have to reverse split, it really doesn't matter at all. But the perception is there. So people look at it and say, well, is that good or bad? But from a financial standpoint, it doesn't change a darn thing. So it doesn't matter. Just like the yield does not matter, whether it's 10%, 20%, 50%, or 100%, it does not matter. It's not yours. It's a combination of maybe some income and giving you your money back. So with that said, I offer the following chart. So here's my chart. This is the total return for a few different ETFs over the last 3 years. Remember, total return includes all dividends and distributions reinvested. So as they pay you out, you put it all right back into the fund so that we can compare one investment to another. And by the way, we've been on a nice bull market during this 3-year period. So I picked SPYI from Neos. This is a covered call ETF. It's well put together. I do own shares of this. And it's been around for a long period of time. So because we have 3 years of information, it's a good one to use as our base case here. So we've got SPYI, total return, last 3 years up around 65%. VOO, right, the S&P 500, that's what we're going to use as a representation of the S&P 500, up about 90%. So remember, SPYI is based upon VOO using a covered call strategy. Then I also put in here VYM, which is also from Vanguard, but this is a dividend yield product, right? A lower volatility product. And then we have QQQ that I also tossed in here. That's the NASDAQ 100, which has higher volatility. And again, we're on a 3-year bull run here, so you can see how it does. So with that in mind, I want to introduce the concept of beta. Beta simply allows us to compare volatility of one product with another, and we do this by comparing different investments to a benchmark. So in this case, our benchmark is VOO, or the S&P 500. And we're going to see how these other products compare from a volatility standpoint. So if we look at SPYI, which sells covered calls against the S&P 500, it lowers the beta of our portfolio, or the volatility, from 1 to about 0.7, 0.75, right in that ballpark. Whereas something like VYM, which is again a dividend yield, lower volatility stocks, this one also has a beta of around 0.7. And then we can go out and have a higher beta, of course, as well, with something like QQQ, which will have a beta around 1.15 to 1.2. So we would say about 20% more volatile than VOO. So we can think of beta as our exposure to the market, or our market risk, versus our benchmark. So if I sell a call, what happens to the volatility of my portfolio? It goes down because I'm applying a small hedge, right? I mean, I'm capping my upside, or we could say I limit my potential return. But I get to collect a premium. So during a decline, I don't decline as much. I essentially lowered my beta, or lowered my volatility versus the underlying. And that's exactly what we see here with SPYI in this case over the last 3 years, right? We might call this product the S&P 500 Lite version. So just to take this a step further, let's think about how alpha and beta work together. So if the S&P 500 was expected to return, let's say, 10% this next year, what would we want to get by taking more market risk? We would want a higher return, right? So if I'm going to take on more market risk by buying, let's say QQQ, for example, I would hope to get a higher return. So let's say its beta is that 1.2. My expectation is that I would get a 12% return in a year where the benchmark is expected to return 10%. But this also works in the other direction as well. So the expected benchmark S&P 500 was expecting a down year, let's say expected to lose 5%, I would expect QQQ, more volatile, to lose maybe 6%, right? 20% more. So we will not always be in a bull market. And again, that's why I bring up the fact that we've been in a 3-year bull market. Now, if you are truly seeking alpha, you should be looking for a return that is above the expected return for the amount of risk that you're taking on. So lower beta with a higher alpha. So a beta of 0.8 in this example, maybe something like SPYI in the above example, would have an expected return around 8% based upon that 10%. If you actually got 10% from SPYI, you would have found alpha, right? This is what we mean by seeking alpha, which also happens to be the platform you're staring at right now. By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So if you are looking for a stock and ETF research tool, consider Seeking Alpha and check out the links below for discount offers. Anyway, back to the covered call fund. Apply this to SPYI. And what should we expect from it when we lower the beta of our portfolio by selling covered calls, right? A lower return during a bull market and a lower loss during a market decline, right? It's lower volatility. Now, there's absolutely nothing wrong with this except to say, do you want to lower volatility right now? And I see more and more young people and young YouTubers out there talking about these as a source of income. And I think they just don't get it. So I have a young son. He already started investing. If he said, Dad, should I buy this covered call fund? It yields 30%. What do you think he's going to hear from me? He would say, you are young. Embrace volatility. Don't try to tone it down. You've got a long time horizon, young man. Go for it, Embrace it. So covered call funds and covered calls in general it's going to sound a little harsh. I'll put myself in this group, but for old people, right? Or for someone who wants to actually seek alpha from trading options themselves as an expert. So how and why do I use these? Well, we'll get into that. But just remember, we've got VOO, the S&P 500. We've got SPYI yielding a lot, but having a total return similar to a dividend ETF, right? Pretty close and in line. We've toned it down. You could just be writing QQQ and having a lot more money. Sounds pretty good. So why would I buy these? How do I use these? Well, as you get older and maybe head towards retirement, volatility ain't so great. So you might want to lower the volatility of your portfolio or reduce your beta at that point in time. And that's when buying more conservative stocks or maybe even a covered call ETF might make more sense. These also have shown that within an ETF wrapper, they can be quite tax efficient. So depending on your situation, that could also be a factor. So I bring in the following chart. So here's my bargain that I make with myself. Whenever I buy something like the S&P 500, for example, VOO or SPY, I allow myself to add a little bit of SPYI, GPIX, TSPY, some of these different ones that we've talked about. This has, there's two functions of doing this. One is the underlying tends to outperform, and I want that performance still. And they're also cheaper to own, right? That expense ratio is quite high on a lot of these covered call ETFs. I don't like those expenses. So that's my bargain. So can I get away with 50-50 in this case, right? Instead of maybe a 10% yield from these products, I end up at 5%, but it's pretty tax efficient. That makes sense, and that's how I've been utilizing these. You extend this further as well. You can look at the NASDAQ 100 with, hey, I'll buy QQQ or QQQM, or even a more tech-heavy thing like VGT, right, a great ETF. And in doing that, maybe I'll also add some QQQI, GPIQ, TDAC, that's a brand new one. So we'll look at that one soon. Haven't reviewed that yet from Tap Alpha. Then we got IWM, if you want the Russell 2000 with IWMI. Bitcoin, you can even do it with Bitcoin now if you're a Bitcoin person. IBIT, right? I own that, and I also bought a little bit of BTCI. Maybe you can combine those two. A lot of these are NEOS products. They just came out with this, and I reviewed a lot of these recently, so they're kind of on my mind. How about AAAU for gold? But then you can also monetize that and go with IAUI from NEOS, which will give you a nice yield off of that. And then international. I really like the idea of going international. VXUS is extremely broad. IDVO from Amplify is a good solid fund, and NEOS also came out with one just recently over the last week. So pairing these up, maybe you can live off a little less yield. How much growth can you afford is the point. So there you have it. If you're young, my suggestion is go and embrace volatility, and for God's sake, stay away from the Tylenol. All right, that's a joke. Yeah, I think if you can tolerate the volatility, that's what you do for as long as you possibly can. I think you'll look at better returns overall in the long run based upon everything that I look at. Now, any questions on this, ask down below. If you're looking for more content like this, check out one of these videos and like and subscribe, and we'll see you next time. Have a great night. Whoop.